Hey everyone, welcome back to the channel. If you've ever felt like the stock market is just a wild, unpredictable roller coaster, you're not alone. But what if I told you there are patterns, rhythms, and cycles that can help us make sense of the madness? Today, we're diving deep into stock market trends and cycles. We'll cover what bull and bear markets really are, how economic cycles influence everything, and how you can start spotting these trends yourself. This is crucial info for any intermediate investor looking to level up their game. So, let's start with the basics. Bull and bear markets. You've heard the terms, right? A bull market is when the market is on an upward trend. Prices are rising and investor confidence is high. Think of a bull charging forward, horns up. On the flip side, a bear market is when the market is declining, prices are falling, and pessimism takes over. Picture a bear swiping its paw downwards. These aren't just random mood swings, they're often tied to broader economic cycles. The economy doesn't just grow in a straight line, it moves in cycles, typically with 4 key phases. First, we have expansion. This is the good times. The economy is growing. Jobs are plentiful, businesses are profitable, and stock prices are generally climbing. This is when the bull market roars. But nothing grows forever. Eventually, we hit the peak. This is the top of the cycle. Economic growth starts to slow down, and inflation might become a concern. The market might still be high, but the smartest investors start to get a bit cautious. After the peak comes the contraction or recession phase. Economic activity declines, unemployment rises, and corporate profits shrink. This is when the bear market usually shows up. Fear and pessimism can grip the market, leading to significant sell-offs. Finally, we hit the trough. This is the bottom of the cycle. The economy has bottomed out, and things start to stabilize. It might feel bleak, but this is often the point of maximum opportunity for investors who see the potential for recovery. And from the trough, a new expansion phase begins, and the cycle repeats. Let's look at some real-world examples to make this concrete. The most famous one in recent memory is the 2008 global financial crisis. We had a massive housing bubble, which was part of the late expansion and peak phase. When that bubble burst, it triggered a severe recession, a classic contraction phase. The stock market crashed, entering a deep bear market. But after hitting a trough in early 2009, a new, incredibly long expansion began. This led to one of the longest bull markets in history. More recently, think about early 2020. The pandemic hit, and the global economy slammed on the brakes, causing a sharp, sudden recession. The market plunged into bear territory almost overnight. But then, massive government stimulus and swift central bank action helped the economy find a quick trough. What followed was a surprisingly rapid recovery and a roaring bull market that took many by surprise, especially in tech and growth stocks. This shows that while the cycle phases are consistent, their length and severity can vary dramatically. So, the million-dollar question is, how can we spot these trends and transitions? It's part art, part science. No one has a perfect crystal ball, but there are clues. One of the most important tools is trading volume. High volume during a price increase is a strong sign of a healthy uptrend. It means a lot of people are confidently buying in, but if prices are rising on low volume, it could be a warning sign that the trend is losing steam. Conversely, a price drop on very high volume can signal panic selling and the start of a downtrend. Then we have technical indicators. You've probably heard of things like moving averages. A simple moving average, like the 50-day or 200-day, smooths out price data to show the underlying trend. A common bullish signal is when the shorter-term average, like the 50-day, crosses above the longer-term 200-day average. This is called a golden cross. The opposite, a death cross, is a bearish signal. Another popular indicator is the Relative Strength Index, or RSI. This is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100. A reading above 70 is generally considered overbought, suggesting the asset might be due for a pullback. A reading below 30 is considered oversold, suggesting it might be due for a bounce. Using RSI can help you gauge whether a trend is becoming exhausted. Don't forget about sentiment indicators too. The Fear and Greed Index, for example, measures investor emotions. Extreme fear can be a buying opportunity, while extreme greed can be a signal to be cautious. Remember what Warren Buffett says: "Be fearful when others are greedy, and greedy when others are fearful." Now, it's crucial to combine these tools. Don't rely on just one indicator. Look for confirmation. For example, if you see a death cross on the moving averages and the RSI has been showing a bearish divergence where price makes a new high, but the RSI does untrade and volume is drying up, that's a much stronger signal that the trend might be reversing than just one of those things alone. You're building a case, like a detective, using different pieces of evidence. So let's wrap this up. What's the key takeaway? Stock market and economic cycles are a natural and inevitable part of investing. They've happened throughout history, and they will continue to happen. Instead of fearing them, we need to understand them. Recognizing the different phases, expansion, peak, contraction, and trough can help you manage your portfolio and your emotions. Using tools like volume analysis, moving averages, and RSI can give you an edge in spotting potential trend shifts. Remember, the goal isn't to perfectly time the market top and bottom every single time. That's nearly impossible. The goal is to be prepared. During expansions, you enjoy the growth. As you approach a peak, you might become more defensive. During a recession, you look for opportunities to buy great assets at a discount. Understanding cycles turns you from a passive passenger on the roller coaster into an active driver who knows when to hit the gas and when to gently apply the brakes. I'd love to hear your thoughts. What trends are you seeing in the market right now? Do you have any predictions for the next cycle? Drop a comment below and let's start a conversation. Thanks so much for watching. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more content to help you become a smarter investor. See you in the next one.